All right, folks, welcome back to the channel. This is Jason, host of Fighting Words Financial. And so I didn't have very much time to prepare for today's live stream. Did some work early in the morning, just got back on and checked markets today. I did see that they were up pretty early, and we've had a strong run for most of the day. So as the markets are coming to a close here, it looks like the NASDAQ is up 215, just about 1.8%. Did the math on that, and basically Tesla accounts for about 0.2% of that. Even though it was very broad, Tesla's accounting for a pretty large percentage of that. The S&P 500 up 25.51, up 0.6%. The Russell 2000 up 1.5%. We're really seeing a lot of movement in small caps right now, so that's definitely something to keep an eye on. And the Dow Jones up 44 points. And remember, my screen here is probably delayed. But yeah, energy looks like it's rebounding off of its low from earlier in the month. But we're going to take a look at what's going on in the in energy markets here too in just a moment. But let me know what you guys want to talk about today. I did put out a video a little bit earlier in the day talking about 4 recovery stocks that might be a good idea for you to investigate. We are going to see a pretty large turnaround in trading, whether or not the market is good or bad. We're going to see a lot of activity, and companies that stand to benefit because of market activity, whether or not the market goes up or down, are financials. They make a lot of money in trading. And with the amount of money that institutional investors have in cash right now, it's roughly 5 to 6% of their portfolio. That's at relative historical highs. It's higher than any period since 2001, which signals that money is sitting on the sidelines because they're looking to make a move. So other companies that are making a move, but not necessarily for the same reason. Right now, we're seeing Berkshire Hathaway kind of going on a buying spree. They're repositioning. They accumulated a lot of cash up through the beginning of this year, according to Charlie Munger, not because they were waiting for a market downturn. It's because things had gotten so expensive that they couldn't find value. And let's remember, they are value investors. They're searching for low PDEs, stocks for the most part, who have a history of dividend growth. This is their style of investing that has served them very well. Excuse me. And they have a time horizon of essentially forever when they buy a stock. That's essentially my time horizon when I buy a stock, although our investment philosophies and styles are a little bit different. I tend to be a bit more technology focused than someone like the managers at Berkshire Hathaway are. But yeah, so I did want to take a look at a few things today. The NASDAQ jumped today pretty hard, but it's really the relief that things aren't as bad that we as we thought they were going to be. Stocks rise, fueled by a tech rally as all major averages touch highest since early June. I don't expect volatility to be over to any degree. This is really another day of mixed news where companies are meeting the reduced guidance that they reduced their guidance after last quarter. They're meeting that and exceeding that in a lot of cases. They're doing fine on revenues, but earnings are taking a hit. So we are looking at a bit of a balance sheet recession, even if we are in an actual recession. But yeah, so NASDAQ Composite rose Wednesday as traders weighed the latest corporate earnings for signs that profits will stay high enough to boost the market. So NASDAQ jumped 1.42% and the S&P 500 advanced 0.51%. Meanwhile, the Dow Jones average lagged behind the other two benchmarks. Not surprising, though, largely because of how beaten up technology has gotten. So the information technology and consumer discretionary stocks led gains in the S&P 500, which each sector up more than 1% on Wednesday. A lot of that, of course, had to do with Netflix. Netflix did not have a good quarter. It wasn't as bad as expected, only losing 970,000 subscribers instead of the 2 million that it had projected. The earnings per share came in above analyst expectations, but let's remember these were downwardly revised expectations. So shares jumped more than 5%. Disney advanced 3%, Paramount climbed nearly through 3%, and Roku surged 5%. I still think that Netflix has a little bit of trouble ahead of it. A lot of what they relied on before were properties that are now being moved to other streaming networks that actually own those properties. So Disney's taking all of their stuff off of Netflix and putting it onto their own network, particularly these like big universe type developments like the MCU, Star Wars, that sort of thing. So semiconductor stocks advanced, and that's really about all the talk going on with the semiconductor bill that's being debated or created in Congress right now. Someone asked me which company is going to benefit the most. It's going to be every company that is probably in Europe or the United States. So Janet Yellen has been talking. Janet Yellen, who's now I forget which department she leads right now, but she's actually talking about friend shoring, production of certain critical items for our economy, meaning that we're not necessarily going to bring all production back to the United States, but we will be bringing or trying to bring production back to friendly countries. And Europe would probably be one of the biggest beneficiaries of this. So when it comes to the semiconductor industry, where I'm going to start looking at opportunities is going to be in the United States and Europe at this time. So more news coming out about the Bank of America study that I referenced yesterday, stating that investor sentiment has really deteriorated and people are reaching sort of peak sentiment in terms of negativity, and that's actually a good sign for a rally. The dollar has surged to a 20-year high. That has actually softened a little bit, so that's good. So I think that's one of those are combined. Those are a bunch of reasons why the market is doing a little bit better. Also, we have a lot of earnings that are coming out this week. So 12% of the S&P 5 companies have reported earnings so far. 68% have beat analyst expectations. Investors have been waiting for this earnings season on clues for how they're coping with the worst in worst inflation for you. So Baker Hughes dropped 7% of their disappointing quarter earnings. Their oil field services company reporting an earnings of 11 cents per share, which is half of what analysts were expecting. That's actually a big one, folks. Biogen declined more than 6% despite beating in its latest quarterly report. Man, when it comes to biotechs, sometimes the quarterly reports and the market reaction to that don't make a ton of sense at all. It really doesn't. But a lot going on this week when it comes to earnings. Tesla earnings, as Michael Will points out, Tesla earnings are being released right now. There's going to be an earnings call, I think, in about an hour and a half. I'm not sure. So he's right that I'm going to be competing with all the Tesla YouTube channels right now. In the past, this may have seemed like a Tesla YouTube channel, but it is definitely not. I have not seen the earnings yet. They were just released a few minutes ago. But what I can probably say is that profits are going to be pretty heavily impacted by all of the things that went on last quarter, most notably lockdowns in China. Ramp up at Gigafactory Austin, though, has been going about as well as expected. There are a lot of labor issues right now at Tesla factories, and that's something that may affect production going forward. That's not something that's getting a lot of press, but there are a ton of labor issues there. And like if you know people in particular that work on the factory floor, they will let you know what those issues are. And in fact, there's a lot of those employees have options now. They can go to Rivian, they can go to Lucid, they can go to a half a dozen other startups that are out there. Some of those startups might not be around in a couple of years, but yeah, we'll see what's going on there. In terms of energy news, this is really the big news here. Gasoline prices seem to have peaked about 3 or 4 weeks ago, and could be headed below $4. And I think September is when we see the bottom drop out of gas prices, unless something else happens with the war in Ukraine or further constriction in supply. There's a lot going on right now when it comes to pumping. Actually, Baker Hughes was mentioned in it was mentioned in the previous article that I mentioned. And one of the ways you can think about future oil production here is to look at this survey right here, which is the Baker Hughes rig count. Now, there's a lot of actual misinformation out there on the internet right now in terms of how much drilling is going on. So we're looking at in the US as of today, we have 756 active drilling rigs. This is exploration. This is up from just last month, and it's up 272 from last year. So that's roughly 50% growth over last year in terms since July 16th, 2021. Canada has added 16. They have 191. I think I misquoted that, and they're up 41 uh, rigs from last year. That's close to 30% there. So internationally, there are only 824 rigs out there. The change internationally is only 7 per month and only 66 for the entire year. The bulk of new exploration is being done here in the United States. And I think that says a lot about which societies and countries are doing something to alleviate the oil crisis here. And of course, that's all driven by economics. A lot of the oil that can be recovered here in the United States is only profitable at a higher price point. So there you go. Now, rig count is down from years ago, from like 10, 12 years ago. A lot of that has to do with the difference in technology and not necessarily the fact that we aren't drilling as much. So this is probably the best resource that's out there, which is to go directly to Baker Hughes. This is kind of a monthly survey that they do. It may even be weekly. I'm not sure, but I know it's a monthly survey at minimum. And a lot of the information that you're seeing out there is relatively outdated or kind of spun to you in a way that's influenced by politics. So if you're hearing that we're not drilling for oil, or you're hearing that it's responsible, this is really the responsibility of any government policy, that really isn't true. And the numbers, if you take 5 minutes to look into them, would tell you that that is not true. So yeah, you guys fire away with the questions. I didn't plan on a really long live stream today like I did yesterday. I actually started losing my voice yesterday. And then right after I do my live streams, I basically take a shower and head into the gym and teach at my academies, usually on Tuesdays and Thursdays and Saturdays. So yeah, let me know what you guys think in the comments about Tesla's earnings. I think they're going to disappoint to a degree. I think the market is relatively prepared for disappointment. I mean, I could be being disproven right now as I'm speaking, but I'm going to say that their earnings are going to be impacted significantly. I'm not saying they're losing money in this quarter, but it's definitely possible. And remember, they have about a $460 million write down on their Bitcoin holdings too. So that's going to significantly impact the way their balance sheet looks and the way their profits look too. So yeah, give me your opinion on what you think about Tesla's earnings. I'm a little disappointed in Tesla right now when it comes to the pace of introduction of new models. I really feel like they should be working their way down the value chain to an even broader market. I think that would do a lot to help out their brand. And I think that as they're entering into an era of greater competition, they don't face risks of going out of business. I think they've established their brand enough that they're always going to be that sort of luxury, high-end vehicle status symbol that people like. But when it comes to the lower end of the economic scale there, I think they're going to face significant competition from other folks who have some really, really good vehicles. And there are hundreds of them being produced worldwide right now. And I think it's very exciting. But yeah, in terms of energy news, really, I think this is some of the best news that's out there right now about gasoline prices, probably heading below $4 a barrel. $4 a gallon rather. So yeah, so they peaked in June at an average of 5.01 per gallon, which I would love to have paid $5 a gallon. It was like 6.86 per gallon in California right before July 4th. It has dropped over $1 since then. And yeah, but I think Labor Day could end up being the cheapest summer holiday at the pump, says Gas Buddies Patrick DeHaan. We have expectations for what shows up in economic data. We have no expectations for what turns up in the Atlantic or the tropics. The wild card this year is the hurricane season. Yeah, that's always the wild card there because a lot of our refining facilities are located on the Gulf Coast. And of course, a lot of oil is shipped from overseas via the Atlantic. So the wild card is always hurricane season. That is nothing new. This year, though, because it does seem to be unusually hot, at least water temperatures seem to be unusually hot on the East Coast, we could be in for a very active hurricane season. And that's something actually that if you're familiar with the oil industry, ocean temperatures is something you definitely pay attention to because that's going to indicate or give you not a firm indication, but an idea of how many storms you're going to have in a year and how much that's going to disrupt supply. So I've never been a oil futures trader, but I used to, back in the old days when I worked at a trading house and I was in IT, those guys would pull their hair out during hurricane season, just trying to run the numbers there and make a profit on oil futures. And I thought that was one of the most stressful jobs in finance, was trading oil futures during hurricane season or anything else like that. So, okay, so drivers in Georgia are paying relatively low, $3.98 per gallon. In California, you're paying $5.84 for a gallon of unleaded. That's relatively accurate. I'm pretty sure I saw exactly that price today as I was driving around. So, but in terms of the economy here, we aren't seeing the sort of doom and gloom earnings that were predicted. Absolutely not. We are seeing a ton of positive news here going around about earnings in terms of meeting those reduced expectations. We are seeing retail sales are doing a little bit better than we anticipated them to be, but inflation is entrenched. It is eating away at your earnings power. The benefit right now is that the labor market remains strong. Now, I have a lot of folks that I know who are looking for new jobs, trying to climb that income ladder out there. The labor market has a long way to go before it starts to not be as friendly or not be advantageous to switch jobs, right? So we're still having, unemployment claims at under 300,000 a week here. This is really good. Typically, if unemployment claims are under 350,000 per week, that sort of indicates that we have a really hot labor market. When it gets above 350,000, it becomes a little bit, it comes less than hot, of course, but certainly not bad. At over 500,000 or so, you're looking at a labor market that's going to be quite a bit more challenging. But yeah, the is going to slow significantly. Hopefully, that is not tipping us over into recession. And that's one of the things that's one of the things that Powell was saying in some interviews earlier, is that he does think that the markets and the economy are going to slow significantly. So, but yeah, I want to know what Tesla's earnings are like. I think there's been a couple of times when Tesla's had like really bad earnings, but it wasn't quite as bad as the doom and gloom. Yeah, it wasn't bad as the doom and gloom expected, and the stock absolutely took off. So let me see. Michael Willis taking a look at Tesla earnings. As of the end of Q2, we've converted approximately 75% of our Bitcoin purchases into fiat currency conversions in Q2, and added 936 million cash to our balance sheet. Very interesting. Very interesting. So we're not, of course, privy to those Bitcoin trades before they go through, but I do think it's interesting that they timed that fairly well. So yeah, what's going on in China right now has me a little bit concerned about the global economy still. So lockdowns in China are still happening. The BA.5 variant looks like it's hit there. They're spending billions and billions of dollars on testing right now. I think we can see further localized shutdowns in the economy. Oh, in fact, here's the article on this right here. And this is what I was reading about. I didn't read it from this website, though, but things aren't looking good for China as another wave sweeps the country, causing uncertainty for businesses and confusion among residents. COVID restrictions. So most of China's 31 provinces have reported new cases in the past weeks. The worst flare-ups since Shanghai and elsewhere brought their April to May outbreaks under control. This month, new cases have leapt more than double the number of June. Monday's new cases totaled 776, a steady climb since the beginning of the month. So in the United States, the same thing is happening, but we aren't reacting the way we did before. And I'm not going to minimize the impact of people who are affected by COVID. Not at all. What I'm saying is that China's response is very, very different. They have really heavy-handed, localized shutdowns. Right now, more than half of these cases are in Guangxi, next to the world's workshop of Guangdong province in Hong Kong. This is where this is part of the Pearl River Valley, and there are 57 million people or more that live in that region. And this is the beating heart of the world's economy, and it produces much of China's nickel, aluminum, and other raw materials. So most of Gansu's capital, Lanzhou, said it would be locked down till at least July 24th. President Xi Jinping has made one thing clear. China will not waver from its zero COVID approach, which means quashing cases regardless of social and economic consequences. But local level approaches continue to evolve. The 2-month Shanghai lockdown became a worldwide scandal because of its draconian measures, partially as a result of that fallout. Outbreak responses, while still harsh, have become more targeted and reliant on testing. The rules have not become clear. In fact, the greater autonomy Beijing has given to localities has resulted in fragmentation of information across the country. Foreign business people barons spoke within 3 cities with current outbreaks, lamented the ongoing uncertainty that clouds their operations. And this is really kind of the key, ongoing uncertainty. And it's just not creating a business environment that is conducive to investment. And foreign investment into China has slowed significantly. Business needs predictability. And this is what the article says. It's also true at every level, certainly at the national level. And China's chaotic and haphazard zero COVID policies offer neither. And I think that spells more trouble for if they continue on this zero COVID policy. That spells more trouble for Tesla down the road. Hopefully, these factories right now that are burning $1 billion a month, like Tesla Gigafactory and Gigafactory Berlin, hopefully they start to scale production and pick up the slack for what China is not producing. So last week, new outbreaks grew alongside weaker than expected second quarter economic data. Goldman Sachs Group downgraded its 2022 growth forecast for China to 3.3% from 4%. So by any standard of the definition, 3.3% growth in the United States would be really, really good. And 4% is at least 4% sustained over a long period is probably overheating. So China, for a very long period, has had economic growth much higher than that 4% level. But let's remember, they've been dragging more and more people into China's middle class, and because they had much further to go. China really sort of began to be engaged in the world economy back in the mid 1980s. That really picked up steam in the early 2000s. But they have a lot to do in terms of development, and so the growth of this country rather, their economy has looked more like an emerging economy than it has a more mature economy for the last 2 decades. But as it is becoming, and it's definitely, the second largest economy in the world, but in a lot of ways, it still isn't the most developed economy. So, yeah. And there's some other information on here, but paying attention to what's going on in China, because they're the source of many goods we get around the world. They're the source of a lot of supply chain issues right now. And I'm not blaming China for this. What I'm saying is that there's just a crap ton of stuff going on in that country. Uncertainty regarding China's zero COVID approach. And of course, the lack of resources to care for our population if we did have a massive COVID outbreak. So, and this is the grim prediction here that is probably one of the more concerning things for the stock market, even though on the surface it appears to have nothing to do with the stock market. And this is what I'm talking about. There will be a wave of emerging market defaults, says investor who seized one of Argentina's ships. Jay Newman was something of an emerging markets legend. At Elliott Management, he led their successful campaign to get Argentina to pay out on defaulted debt, which included the seizure of a naval vessel with sailors aboard to the tune of $2.4 billion. Now he's expecting debt epidemic. We are on the brink of an epidemic of emerging market defaults, the scale and scope of which will rival the debt crisis of the 1980s, which nobody reading or listening to my channel probably is old enough to remember that, since my listeners seem to be quite a bit younger. But you may not be old enough to remember the debt crisis of the 1980s. It was a serious issue, and it did affect the world economy. And it's more likely to do that today. And so I talk a lot about the Fed's response to inflation, and I talk about the Fed's power to affect money supply. But let's talk about a few things that they can't control. They absolutely cannot control what China does in order to facilitate or hinder their supply chain management and how that stuff comes out to the United States. There's nothing the Fed that can do about that. All they do is they control monetary policy, right? And they do that by lowering interest rates, by facilitating the sale and purchase of U.S. bonds on the open market, and of course by controlling deposit rates at banks and a few other policy decisions that they make. The difference between now and the late 1970s and early 1980s is our economy is actually a whole heck of a lot more internationalized than it was before. So while they have a lot of power to constrict money supply here and decrease demand by throwing us into a recession, if that's how they choose to handle it, what they don't have control over are any of these external factors. So keep in mind that the power of the Fed is they're not powerless, but they're far more limit. They have more tools than they did in the 1980s to combat inflation, but they are limited by the fact that we have a lot more international partners now. And that's one of the important things to consider. So inflation is embedded now. I think we may have peaked, especially when we're looking at some of the data that's coming out over the last month. A lot of that has to do with the increase or decrease rather in energy prices. I want to see what happens with months or with numbers next month. Um, so Newman, not uniquely, it says that China has laid a debt trap to seize key assets across the world. This is very interesting. If he is looking at a wave of defaults and he is sort of positing that China has laid a debt trap to seize key assets across the world, when Sri Lanka predictably finds itself unable to satisfy the debt, China sprang a trap on them, insisting on repayment and offering to exchange debt for further concessions in vast tracts of land and offering additional cash to help until tide the political class over. So they're doing this with a lot of different countries right now, not just in Sri Lanka. They're doing this all over Africa, and a lot of this is in the name of securing natural resources for the country. Their approach to dealing with the international world has been different than ours. So far, in some ways, it's been less impactful for the indigenous populations of those countries than our approach has been. So, yeah. Here we go. So I noticed that Ford plans to lay off 8,000 workers from internal combustion engine plants, supposedly to better compete in the EV market. So I'm not sure if that's solely to compete in the EV market. They have a lot of dead brands or a lot of dead models under Ford right now that probably should be discontinued anyway because they don't sell that well. They probably want to discontinue some of those lines of production. Some of those workers probably can be retrained to work in the EV market, but I think they're also making room on their roster to take some of these employees that are dissatisfied with working with Tesla at this point. Tesla's driving their workforce to the breaking point in their factories. And there's a lot going on in the rest of the company where people have a lot better working conditions, but factory workers, because of the intense demands that they've been under in the last really 6 years to produce, they're under tremendous. And I know not just one, but I know like 4 people that work in Tesla plants that are looking for other jobs right now, and they still want to be involved in the EV world. At least 3 of these, not one, but at least 3 of these out of the 4 are sort of EV and evangelists. They want to stay in the EV world because they believe in having this carbon-free future. But the working conditions are not great, and it's just because they can't produce enough to satisfy demand. So Ford has really ambitious plans when it comes to EVs. They have really been the first company of the more traditional automakers to step in. Well, really, the first one was Volkswagen. Out of the traditional automakers, they were the first one to step in and saying, "We're going to have a comprehensive EV strategy," and Ford is kind of number 2. And it actually surprised me that their first. I mean, they made smaller moves in EVs, but the first big move in EV was the Ford Lightning, which is basically an F-150. Which is the greatest selling vehicle in the United States for 40 years running without any sort of competition whatsoever. And I think that's very interesting that they're doing that. But I think you're going to see a lot of layoffs from a lot of different companies, but they're going to be hiring in other areas as we're seeing priorities shift in the economy right now. People are trimming some of the fat, and they're looking for better quality people or people with the skills that they need rather than just warm bodies. For the last year or so, it's been put warm bodies wherever we need them. And I think that is changing a little bit. The market really still favors employees in a lot of ways, though, which I find very interesting. I've never experienced in my life a labor market where labor had so much power. And I think this is a good thing. And I think the increased earnings are a good thing. We simply need to control inflation. And then I think that having workers earn more money is better for the economy in general. So, yeah, home prices hit a record sales fall as buyers throw in the towel. So housing falls again. This is all news that if you've been watching my channel, you probably expect to see. A lot of that is just driven by the cost of debt at this point. And yeah, so fire away with the questions, guys. I'm going to try to be on another 15 to 30 minutes max. And I really do like to engage with you guys and ask questions. If you have anything particular or really even off the wall to ask or anything, don't worry about it. I'm not going to judge you for anything. So yeah, so let me know what you guys think. And any other news with Tesla earnings as you hear it, go ahead and push that through. I'd love to hear about that too. So anything interesting right now in the news that I see, I'll bring up to you. But I'm not even going to go into this article. This is exactly what we expect. So gas news. I think right now, when it comes to gas news, that Russia resuming gas exports now, of course, they're going to do that. They need the money. Plus, it won't make as big an impact for them to cut off gas shipments now as it will, say, in the November timeframe. I fully expect in the November, December timeframe, when Europe starts to get plenty cold, that they're going to find some excuse or way in order to cut off gas supplies, because that's when it's going to have the most sort of impact on the general European population. And the United States will not have, and United Arab Emirates will not have spun up enough natural gas exporting capacity to make up for that shortfall. It is going to be a cold winter in Europe. Yes, I have made some progress in cybersecurity research, and I'm not going to do anything in the next week or two when it comes to any sort of stock analysis on there. But one of the things that surprised me the most about these cybersecurity companies right now is that they all have massive projects dealing with crypto, massive projects dealing with crypto. So I am really sort of interested to see how this works out. I'm on the fence. I'm always on the fence. I've always been on the fence when it comes to crypto. I don't have that much invested in it. I'm far less invested in the value of my actual tokens than I am in how cryptocurrency is going to evolve as a medium of exchange. I'm very interested in blockchain technology and its applications in the future, but I am a little bit concerned about the crypto market as a whole. For a couple of reasons. Security was one of them, of course, but also the idea of what translates into making a particular token more valuable based on the work that's being done on the network or how many applications it has. There's not a direct connection between those. And that's what I think but most investors are actually missing, is that the value of, just like the value of the dollar, of course, is that the value of cryptocurrency, it only has value because people believe that it has value. It doesn't have an intrinsic value, just like the US dollar does not have an intrinsic value. But in order to create something that has a stable perceived value, there's a lot that's going to happen in the next 20 years. I don't expect to see any degree of stability in crypto for the next 20 years or so. I really don't. Redshift back here. We may see EU countries moving back to coal. Yeah, I think a few of those countries actually can't move back to coal. Those coal facilities they began to shut them down about 10, 15 years ago. And in a lot of cases, these countries are not going to be able to move back to coal because those facilities don't exist anymore. That's not true for the United Kingdom. Those facilities are still around, and a lot of them have been converted to burning other types of material. And I forget what it's called right now, but it's basically compressed sawdust delivered from the United States and Canada from logging operations. It's just compressed into these pellets and is burned. I forget what that's called. But yeah, the EU moving back to coal, there are a number of countries that are going to find that difficult. And the largest one of those is going to be the largest country in the EU, which is Germany. they dismantled all of their coal power plants not a few years ago because they got rid of because they were trying to figure out what they wanted to do. Then they shut down all of their nuclear power. Then they kind of went back to coal, but the reality is they just don't have enough capacity to do that right now. So they do have some coal power plants that are back online, but we may be seeing a shift back to nuclear. And when it comes to green energy, you really want to kind of shift your definition as far as what is actual green energy. And I think nuclear kind of has to be on the table. Now, of course, we'd all like that to be fusion, where the waste product is helium, and the world is actually running out of helium as well. And the energy should be free and relatively continuous. But we are a long way away from fusion being a reality. I've been following fusion technology since I was really young, like in elementary school. And I spent years getting excited over each new incremental breakthrough. And I know some really exciting things have happened recently in fusion technology, but I'm not going to get excited until they actually have a power plant working. I'm just not going to do that because I've been disappointed so many times before. But I will admit some of the recent developments in Switzerland and at MIT have been really good. Let me see here. Russia has already stated that due to sanctions, they may not have the parts to keep gas supply running or even turn the pipes back on after the current planned maintenance. That is possibly true. I don't know. Yeah, that is possibly true. I don't know. We just don't know how much is propaganda and how much is reality out here. So, how big of an impact will Twitter have on Tesla stock in the coming months? Your thoughts? So there's a number of people on my channel who have actually contacted me and said, please don't talk about Twitter anymore. And I haven't really addressed it in depth other than to say that from the very beginning, I thought the deal would fall apart for a couple of different reasons. I thought the deal would fall apart because I don't think that the business is monetizable in the way that that like a Facebook is, right? And the fact that most people actually consume Twitter in a secondhand manner, like you and I probably don't go on Twitter every day to see things. We only go on Twitter after we see a newspaper article or an article on the web that says somebody said something ridiculous, offensive, or really impressively smart, and then we go check it out, and then we jump off and we're not on it for a month again. And my problem with this has been the limited amount of people that actually use it on a day-to-day basis, and these are people that are self-promoters for the most part. And it's intellectuals, it's athletes, it's politicians, it's celebrities, but an average people just go on there basically to troll. But I'm not sure how well that can be monetized. And that idea of having a paywall was absolutely dead as soon as it was floated. But there were just a number of different reasons why I didn't think that was necessarily going to work. I expected the deal would not go through, or is going to go through at a reduced amount after we had deteriorating market conditions. But apparently, when you look through the agreement that Twitter put together, and I read sort of an analysis from an attorney on this, they knew all of this stuff going in. I mean, Twitter did, and they didn't have the faith that Elon Musk was really serious about all this, and they put a lot of contingencies in there that are addressing some of the concerns that he may have had. And so really this data sharing argument is the only reasonable thing he has left in order to get out of that. He lost a pretty big bid to delay the trial to the end of the year. Twitter now has a right to like fast track that trial. And I think they want to force a resolution, and they want to force him to buy the company at this point, because if they don't, they're going to be sued by their shareholders. No matter what happens, though, Elon Musk is going to be distracted. He's going to be distracted by the fact that he's going to be spending time making depositions, being in court, and testifying about this Twitter deal. And his focus is going to be off of Tesla, at least in a bit. And how focused is he on Tesla anyway? Look at how much the guy has going on right now. But yeah, a lot going on with Twitter. I don't want to go into too much more detail on that, but I do think it's going to have possibly a negative effect on Tesla, just because he's not going to be so focused on that. So supposedly modular nuclear is a possibility too. It is, although I don't know how modular nuclear power solves the issues of safety that some people seem to have. And I know there's some thorium reactor technologies out there that I haven't looked at it really at all. It's essentially when I run into a brick wall in terms of what I understand, I have to find somebody who is an expert in that subject to kind of consult with me and talk to me about that. Usually, if you contact scientists directly about any research they have, if you let them know ahead of time, I read your paper and I don't understand, they are usually ridiculously happy to hop on the phone with you or hop on a Zoom meeting and explain it to you in terms that you can understand. Additionally, if you see any article on the web that's that's an academic article and it just has the abstract and then the article is actually behind the paywall, you don't have to pay for that article. You look at the authors, you find out where they work, you email them and say, "Hey, I want to read your article, but it's behind a paywall." They'll send it to you. The scientists get absolutely nothing for publishing their papers in Science or Nature or the American Medical Journal or whatever it is. They are more than happy to share that information with you. Even if you're not going to read the whole thing because you know you don't understand it, wait like 2 weeks, email that scientist or doctor back or whatever and tell them you didn't understand. Please explain this point by point. They're happy to get on there and explain it to you. And that's honestly, it's one of the most direct and honest pathways to real knowledge that you have out there. And it's completely available. And it's largely because they are not paid for publishing. They usually work at academic institutions. They get a salary. They might get, you can look up, like, for example, what Dr. Fauci makes based on the different relationships that he has with different pharmaceutical companies and biotech companies and all that. It's actually laughably small what he makes from those relationships. It's not that much money. And a lot of these scientists are in the same boat. So the whole idea that these scientists are on, especially the ones that work for public institutions or are sort of shills for a certain industry, that always makes me laugh, because if they're shills, they're not well-paid shills. Like, I have virtually zero scientists that are involved in biotech who are actually my clients in my financial advisory practice, unless they went out and started their own company, and that's been true for 20 years. The actual scientists who are doing the day-to-day work, they don't make that much money, but they're really happy to share the wealth that they do have, which is their knowledge. Elon's Ozolin says, "I don't mind a cold winter if that will help slow down financing the Russian war, but then again, I am not dependent on gas in my daily life." And you actually are from a country that may be a sort of on the front line here. So sun power, wind power, nuclear Europe should be independent energy. I agree. I also agree that the panic over nuclear power was probably unjustified from the very, very beginning. It's probably always been unjustified. So, that's one of the things that I have yet to understand, that other than Chernobyl, the other nuclear accidents really have not caused the amount of death and destruction they were expected to. Even Chernobyl didn't cause the amount of death and destruction that I think most people expected it to back in that time period. So I'm going to look up a stock here from Hiker Dave. And let's take a look at that. And this is not, I don't think this is a stock that I have looked at before. So all this is going to be off the cuff. So information is going to be limited. In my opinion on this, should be considered virtually worthless. Okay. Decent trade volume at 2.5 million shares per day. No dividend, of course. Earnings is out next week on July 28th. Earnings per share is negative $1.08. Beta, though, is actually highly encouraging. It's 0.54. It means it's less volatile than the overall market. 52-week range, it's anywhere from 36 cents to $4.10. Let me see here. Let's take a look at, and every time I'm on so mean recommendations here are pretty strong, meaning 3 buys. Hold on, 3 buys and 1 hold, no sells or anything like that. And that's true going back across. So there's no negative recommendations here. Earnings and revenue has been all over the map. They've been losing money for years. It doesn't look like they've ever had a positive return here. The earnings beat, earnings missed, plenty of earnings missed the last couple of years. So look, not very strong financially. Let's take a look at this. investment holding companies that uses a car e-commerce platform in China. It provides a selection of used cars, evaluation of car condition, and various car-related value add-on products and services for supporting services. So, okay, I'm already getting suspicious of this. First of all, I'd have to do a little bit more research on this, but I would look to see how exactly they went public. And what I suspect is they actually did what's called a reverse merger, is that they picked a company that was already probably an unrelated company on the NASDAQ that was that was below the $5 mark there. They ended up buying that company in order to go public on U.S. exchange. They did a reverse merger and essentially took over the company, just changed the symbol, and they avoided some of the scrutiny that they would have to go through via SPAC, which SPAC is a different process, but it's very similar to the old style reverse merger. There were a crap ton of companies that did this in the 2008 to 2013 timeframe, and virtually all of them ended up being scams or complete failures. So, and this is, I don't have any evidence that this is the case, but I will say with years of negative earnings here, with you can't tell anything from the earnings. I would take a very hard look at this company. There are a number of different companies out there that had other sort of hard to verify business models back then. Like that, I can't remember the name of the company. It was like China Media something or other, but they claimed that they essentially had a monopoly on a couple of different off the main beaten track like cities. They had a monopoly on advertising in buses and trains there. And it turned out you can't have monopolies on buses and trains there. But they were in business in the United States, and they conducted a couple of secondary offerings, and insiders were able to offload tens of millions of dollars in shares, and they essentially suffered no consequences whatsoever for that. I'm always careful when I look at these small caps in China, especially with something with a market cap of 297 million. I do like the fact that trading volume for something that small tends to be healthy, but it could actually be all of the insiders trading with each other. We don't necessarily know that. So be very careful when you're looking at these small caps that kind of appear out of nowhere in 2018. This one looks suspicious to me. Not saying that it is suspicious, but it kind of looks suspicious to me right now. On July 28th, we will officially be in recession. I can't grasp the idea why the stock market reacts so positively lately. Is it a value trap? It's really because market sentiment has basically bottomed out. And I covered this yesterday that Bank of America on a monthly basis surveys investment managers, like people that manage like giant portfolios, like who manage mutual funds or who manage like pension funds. And essentially, they are sitting at 6.1% of their portfolio value in cash. That is the highest amount since 2001. Typically, that's anytime you're over 5%, that's generally a good indication that we are close to market capitulation. Market capitulation means that's when everyone loses hope, right? Everyone's like, well, a recession's here. The market's going to crash. Well, generally in that case, the market has already crashed. And it's usually a good sign for a relief rally coming forward. And I think that's pretty much what's happening now. If the relief rally may or may not have legs to it. But I do think that right around 3,600 is probably the bottom for this market. That is literally fairly valued for the top of the market back in January. So there's a bit of a phenomenon here, and it was really related to the M2 money supply. Typically, growth in the stock market is 70% driven by earnings and 30% driven by growth in the price to earnings ratio until you have a recession. That ratio was flipped around in this case, in our case, where 70% was growth in the price to earnings ratio and only 30% driven by growth in profits, which should have indicated maybe a deeper fall. Initially, we should have had more of a crash initially, but we were down about 19%. We hung out there for a while. We're back above that now, but it's very close to what is fair valuation of where the market would have been in January if those ratios weren't flipped. So I do think that we're actually pretty close to the bottom of the market. I don't think it gets much lower than 3,600, and it's possible that we touch that once or twice more before we see a lot of growth. So So, hi from Toronto, Canada, and thank you for all your thoughts. Are you personally affected by inflation and increased rate increases? If so, what would you cut back on? So, I am far less touched by inflation in terms of personal consumption than most people are. Part of it is because I just don't buy anything, and I have a garden in the summertime that literally produces most of my food, and I only drive like 3 days a week, and I walk the rest of the time. And I've got a hybrid too, excuse me, that gets really good gas mileage. So I will admit that I have not been affected that much by inflation, mainly because I don't buy much to begin with, which is the reason I have all this money to invest. And I can do live streams in the middle of the day and don't have a regular job. It has more to do with me controlling my spending for 20 years than it does with how much I've earned, right? I put all my money to work for me. So I am personally affected by inflation, but it's really not that much. But the effect that inflation is having on me is really on the businesses that I have, where food costs have gone up and it's reduced the margin that we have on food that's produced at one of my businesses. The price for cloth has gone up, and it has produced it has caused problems at the production level for geese that are produced at my academies. So one of the things that has been massively disrupted that is on nobody's radar is the fact that it has been very difficult to get jiu-jitsu and judo gis for 2 years. For 2 years, it has been extremely difficult to keep all the sizes you need stocked. They're always out of the A2 and A3, which are sort of typical size for the American male, 160 to 200 pounds, right? It's been very difficult to, every time I go on the website to order, they're out. We tried sourcing our own, and shipping has increased. I mean, it's like 6 months before you can get your order fulfilled at this point. Like massive disruption in terms of supplies, and the cost has gotten a lot higher. And these are things that I'm not sourcing in the United States. I'm sourcing them from China and from Pakistan. So absolutely, it has affected me on a business level, but far less on a personal level. Like I probably spend in the summertime more on alcohol than I do food. So, and it's not because I'm drinking that much alcohol. It's just that my garden produces so much in the summertime that I don't have to get any vegetables or anything. I just go out of the garden, pick it, wash it, eat it. And I have a freezer, and I bought a bunch of meat way back in April when there a bunch of things went on sale. And so I haven't bought any meat since April. I've just been taking out of the deep freezer. And yeah, so but I do know a number of people that are in the food service industry, meaning they own companies in the food service industry, and it is the price of the materials they need to produce the sushi that they produce, or produce the one of them has a meal prep company. That is really kind of hurting business right now, because they're not able to pass it on to the consumer quickly enough. It's going to take a while for that to go. So when you say that inflation is embedded, even when prices start to come down at the wholesale level, these companies are still going to have to pass on some of the costs that they absorbed over the last couple of months to the consumer. And it's going to affect prices for quite some time. Even if inflation went back to, went down to 4% today and 3% next month, which is within the acceptable range, it's still going to be months before we see decrease in prices of certain things. I was looking at like margarine is up about 21%. Butter's up about 21% just over the last month or so. Yeah, that's oh, a second. Hi, Jason. Regarding the market bottoming, what do you think caused the drop, and what do you think the condition? Well, it's fear is what caused the drop, right? And the anticipation that earnings were going to be impacted by the higher cost to borrow, and that liquidity was going to be restricted. I don't think that the general public really understands that when the Fed raises interest rates, how that's going to affect the overall market. It reduces the ability of companies with questionable credit quality to borrow, period. And it increases the cost of companies that have good credit to borrow across the board. So that's one of the things. It's mostly fear. The market reacts to emotions, not to facts. And to me, that blows me away that the market doesn't react to facts, but it's actually an axiomatic truth. It is something that beyond being axiomatic and meaning a self-evident truth, it's something that is backed by 100 years of research, is that emotions and perception are far more important than facts are when it comes to the value of the market. Martin Cousineau says, hi, Jason, I hope you're well. I think you rarely talk about corporate, government, and personal debt. How do you think debt can impact the next bull run, short-term or long-term? I think the next bull run, and this is, so I was a fixed income trader for a long time. And while I find fixed income to be enormously interesting, most think it's about as interesting as watching paint dry. And me not being sensitive to other people's feelings at all, it took me probably a decade to learn that nobody wants to talk about bonds. But I am going to address bonds here in this fact that if we do have a turnaround in the stock market or another sustained bull run, it's going to be a very muted bull run compared to what we had before, largely because the option to invest in fixed income has gotten a lot better than it has been in the last 13 years. We've had the worst year ever in terms of bonds. All assets are correlated right now. There's basically no asset across the board that isn't down in the last 6 months, other than oil, and even oil has seen a significant downturn. But this disruption in the bond market is kind of what it needed in order to get back to healthy. There's been very little yield in bonds for years and years and years. Very little yield in other fixed income instruments like CDs. So here's the issue with this. And I worked at a bank brokerage for the longest time. And one of the things that we were constantly told to do was to make appointments with people who had 100,000, $500,000, $600,000 sitting in a bank account or sitting in CDs and get them to try and invest. It is the hardest thing in the world to get those people to invest when you can get a 5-year CD at 4%, or you can get a 6-month CD at 5%, right? Because it used to be that you could get that all the time. For 10 years, you could get from 2000 to not 10 years, but from roughly 2000 to about 2008, you could get a 5% 6-month CD at certain points of the year. It's extremely difficult to convince those people to put their money in. Over the last 13 years or so, as yields on those instruments have been zero. And I used to do a lot of what was called commercial paper trading. Well, this is overnight debts that companies use to fund things on an overnight basis. And I had a huge book of business, a couple $100 million a month that I was trading in really short term, like commercial paper, which that market has basically evaporated over the last 12 years or so. And you could not convince these people to go into the stock market. They would get a guaranteed 4 or 5% over, the possibility of a 7 or 8% gain in the market with the hope of loss, or with the possibility of loss. If we see a normalized fixed income market, I do think that the next bull run is going to be a lot more anemic than the last one was. It's going to be slower and it's going to be less extreme, and it's going to be more of a steady march upwards with, of course, volatility, rather than 20% this year, 30% this year, negative 20% the next year over that. So I do think it's going to be fairly different. It's going to be less volatile than the run upwards, largely because over the last 12 to 13 years, all of those people that love those fixed income options, they didn't have any choice, and they had to go into stocks in order to get yield, or they had to go into REITs in order to get yield. And it's just inherently more volatile. And some of these people are, especially if they're older, they never got comfortable with all the risks that they're going to take. And as soon as they have the option of taking a 2-year CD at 4.5% or a 5-year CD at 4%, they're going to take it. They're going to be back out of the market again. And that's going to cause a slowdown. Do you see a strong or wimpy dollar in the coming year? Oh, we want a wimpy dollar. We definitely want a wimpy dollar. And the odd thing about the United States, which seems counterintuitive, is that the market tends to weaken the dollar when U.S. stock markets and the economy is doing really well, and when the global economy tends to take a dump, even if the U.S. economy is taking a dump, the dollar seems to strengthen, right? And it's all because of our government debt, and our government debt becomes the safest option, even when it's paying 1%, 2%, on a 10-year basis. It becomes the safest option, not the best option. Because a lot of folks are not necessarily investing for that long term, right? They're more interested in safety. And if you've ever studied how pension plans work, you would, and so pension plans, they have a target return generally of like 7% or 6%. And the way they invest is they'll take a slice of their money, like, we must get 5% out of this money. it doesn't matter how we do it, but we have to get 5% out of this money. If we happen to make 8% on that money, it actually meant that we took way too much risk, right? And so they'll move quickly to reduce that risk if they're going over that 5% mark. This is the way a lot of investment is controlled. And a lot of the way they've done that in the past is by buying government bonds in order to create stability in the portfolio. When we have a normalizing market where we have yield that doesn't keep up with inflation, but so in the past, a bond portfolio would have averaged a yield, a total return of about 6.5% per year. That has not been true for a very, very long time, really since the mid 1990s, where we saw declining interest rates from like 1994, I believe, all the way up to up through. We basically saw declining interest rates ever since then, but that hasn't been true. And really, since 2000, the bond market has been very challenging. We're looking at even when you look at a stock portfolio, the lack of yield in the bond market has actually triggered stocks to pay a lot less in the way of dividends as well. They've taken a lot of companies that pay dividends have taken the opportunity to not increase their dividends as quickly as they used to in the past, or to reduce them. It used to be that if you had a portfolio that was producing 10% a year, over the lifetime of that portfolio, it was an all stock portfolio. Roughly 40% of those gains would have come from the dividend yield on that portfolio. Today, that's no longer true. If you look at Bogle, of Jack Bogle, like his prediction for stock market returns in the next generation are like 7.2%. That's what he thinks that a stock portfolio is going to produce in the next 30 years or so. And it's all because he's reduced the amount of contribution that dividends are making to that portfolio down to 2% rather than the 4% they used to be. In the past, he would have made that prediction at right around 9%. And he's making it at 7.2% right now. For a couple of different reasons, I think that may be the case. The normalization of the bond market, though, or the fixed income market in general, though, might actually spur an increase in dividend payout, because it makes those companies which have more limited capital appreciation potential than growth stocks do, it makes them more attractive as an investment when you look at total return. So, and if you look at the total return of a lot of dividend-bearing stocks, they compare fairly well to growth stocks over the long term. They really do. It just takes a little bit more patience to do that. So I've owned one company called Fastenal for years, and when I say for years, I think I bought it around the year 2000. My current quarterly dividend payment is actually larger than my initial investment. So every year I'm making 4 times my original investment just on the dividend payment. It doesn't pay a huge dividend, but what it does have is solid dividend growth over that 20-year period. It's possibly the most boring company in the world. It may be the most boring company in the world. All they make is fasteners, nuts, bolts, clench pins, hitch pins, all that stuff. That's all they make. And they have like brick and mortar stores and vending machines to do that, and a delivery service. But boring can sometimes give you a great return, particularly over time. That steady return that underpins a portfolio. And actually, if you guys paid attention to my video that I made this morning on 4 great recovery stocks, I will likely be buying leap options on 2 or more of those stocks, largely because they represent deep, incredible value right now. They pay strong dividends now. They have a long history of solid dividend growth north of 10%. But I think that in terms of valuation, in terms of P/E ratios, and in terms of how much they stand to benefit on a trailing basis because of the increase in interest rates, meaning we're going to see an increase in credit spreads. They do a lot of investment banking. They do a lot of fixed income trading, right? We're going to see profits increase on fixed income trading because of rising interest rates. This is something that no one's paid attention to for a decade or so. All of these financial companies that I put into that video, I think they're going to go on a sustained years-long run, largely because they got unjustifiably punished. They're down anywhere 25 to 40% off of their 52-week high, or 46% off of their 2-week highs. P/E ratios in the single digits. I think for that industry average PDE would be like 16 and a half. There's only one of those would not be considered absolutely representing deep value in that list. But all four of those, I think, are a great turnaround play. You're likely to get 25 to 50% just for the next 2 years. I am going to choose to magnify that by going deep on Leap's options on a couple of those on the cheap. Well, I can afford to do it on the cheaper one. I can't really afford to do it on Goldman Sachs. But a couple of the others they're a little bit lower priced, and I'll probably be going deep on Leap options, buying them 2 years out. Right. The last time I did this was with Microsoft, and it was actually I did it after watching a video from another YouTuber, and I ended up making like 157%, and that was in 2020 on Microsoft. Right. And it was a leap option. And I've made a couple of other leap options that may actually bomb. I don't know. But it's a great way to use a source of no recourse leverage. Look into leaps if you can at some point. All right. We're on the hour, folks. This is when I told myself I'm going to start getting off so I don't talk all day and I can actually get other things accomplished. I do want to thank all of you for showing up today. I seem to have about 20 regular watchers, which is not great, but I'm grateful for every single one of you. I'm also grateful whenever you guys use the super chat. I don't do it for the super chat, but I'm super grateful for it. I always like to hear from my international watchers too. That's something I really didn't expect when I got started. I don't know why I didn't expect it. It's YouTube and it's international, but that is not something that I expected. So anyway, thank you very much for tuning in today. I will be back tomorrow. Today's Wednesday. Yeah, I'll be back tomorrow, and I'll be taking Fridays off as usual. I'm going to go fishing that day. Let me know if you guys like the video that I put out today with suggesting some recovery stocks, or those are really just quick recommendations for you guys to research. Let me know in the comments of that video if you like that sort of video or what other sort of opportunities I should be presenting. But yeah, thank you very much and have a nice day.